Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at Target, the absolute behemoth in the retail space here in the United States and globally. Let's figure out how much cash flow these guys make, what we think in the future they could possibly generate, and how much the stock would be worth if we did just that. All right, ready? Let's get to work. All right, this channel is dedicated to the rational, cash flow hungry investor. We're going to look through Target here in just a minute. I want to remind you to read the 10Ks every single year for every stock in your portfolio. You know, this channel, we focus on cash flow. You're not going to see any red or green flashy lines here. No bulls or bears are going to go dancing across the screen. No. This is cash flow. What do they make? How much is it worth? What do we want to value the company on? All right, let's do this. Let's get to work. The first thing we're going to do is we're going to review the 5 key attributes that we use here at this channel to value each stock. Number 1, top line revenue growth. You got to have it. Number 2, earnings growth. We use EBITDA, enterprise level. We want to see enterprise level growth. Number 3, strong free cash flow. Number 4, we want low debt. Number 5, we want a well-priced stock. Well-priced being with a conservative forecast into the future. The stock could yield greater than a market return, greater than 10%. All right, let's dive right into it. Target. Here's 9 years of historical financial information for Target. The fiscal year actually ends January. So we've got through January of 2020. There's a new year coming up. Any month now, they should release the numbers. We're waiting on it. I'm going to forecast to get close to what January 2022 looks like, but this number is through January 2020. So you're going to see $73 billion of revenue, and it's kind of bumps up and down a little bit. And they got a nice sizable spike, $93.5 billion when the pandemic struck, and everybody rushes to buy food at home and to stay at home, and they're shopping more. So you can see that when I look into the future, the next 3 months, like next year, which they've already booked 3 quarters of that year, revenue's up strongly again. So it looks like they're keeping some of that. They also might be able to push through some of the inflation we're experiencing in the States on through the customer, and that's moving revenue higher. But overall, I think this checks our box. It's weak, low single-digit growth, but it does check the box for us. EBITDA, enterprise level earnings. EBITDA has grown from 7.7 to 9 billion. Again, kind of rocky, up and down here, except for a nice pop. So I think that's a pattern you're going to see. Is they're very big. It's very hard for Target to move the needle on growth and earnings. They are able to do it if you're a long-term investor, which we are. And long-term, we're expecting low single-digit growth. That's what they've done historically, so I would not expect more growth than that in the long term. Let's go look at enterprise value. All right, so enterprise value always starts with debt. Where are they with debt? Well, 17 billion actually has fallen to 12.6 billion. They're buying down debt. Fantastic. I love seeing that. Cash on hand. They're buying down debt, and they have a sizable chunk of cash on hand. Fantastic. Market cap, shares outstanding times price, $38 billion to $90 billion. That's almost a tripling over that 9-year period of time. Nice move in the stock value. Enterprise value, add the debt, plus the market cap, less the cash, $56 billion up to $95 billion with a strong pop right there at the end of the year. Enterprise value multiple. So this is the number of years of earnings essentially you're kind of paying. 7.2, low of say 6.5, spike to 11, almost 11 times right now. This is measured as of Jan 2020. Stock prices moved up considerably during the pandemic year. So this is basically saying, hey, people think that the earnings are in 2021 are going to be much higher than they were. So they're paying ahead for the earnings. Turns out they're right. Growth rate for 2021 is going to be strong, almost 25% up. Again, based on the 3 quarters that they've booked actuals for, still waiting on the 1 quarter to be published. But it looks like 2021 is going to be a strong year for them. So this taller earnings numbers bringing up the average. But on average, call it an 8x multiple that they can expect anywhere over the next decades, kind of where it trades at. On a debt basis, net debt 2.3 to down to 0.6 times, so very low debt. That's fantastic. That means, this is critical, that means if interest rates rise, right, all corporate debt, most all corporate debt is variable rate debt. They might be able to swap it out for a fixed rate period for some period of time, but all swap agreements end at some point and they have to be marked to market. Furthermore, most corporate debt is what they call balloon payments, where they'll make, interest payments for 3 to 5 years, and there's a balloon payment at the end, and they have to refinance it at that time. What I like about Target is the low debt means A, if interest rates spike, then the interest cost on their financial statement will go up, but it's not going to go up very much because they have very little debt. For companies that are highly levered, like, Ford Motor Company or others that are big, heavy industrials, if interest rates go up, their cash flow is going to go down as they have to fork out more cash for the variable rate debt. But here, that's very, very good. I like that. That's a protection for you and I. It also means that I get upside. I'm an equity owner. That means I get equity value upside, but I have the collateral, the safety of a bondholder because there's very little debt between me and the assets. That's a fantastic position to be in that no one tells you about because everyone's focused on the stock itself. But should the stock really have some trouble and you have to go in and garner the assets and replace management and go through, you as the equity owner have a lot more control because there's no debt in front of you if you have to go to the judge to say, hey, I need to turn this business around. I like that a lot. Let's take a look at cash flow, free cash flow specifically. So the first thing I want to look at is free cash flow from operations. $5.3 billion, $6.5 billion. Kind of, again, same story, up and down a little bit with a sizable pop here at the end, $10.5 billion, 9 times on a consolidated annual growth rate, which is higher than the EBITDA, but still directionally fine. CAPEX, strong capital investment, right? This is building more stores. What I like here, every year, they make enough cash from running their business. This is hard cash money. It's not income that they can represent on the income statement. This is cash that can be verified by a third party during an audit when they just say, hey, JP Morgan, how much cash does Target have in the bank? JP Morgan says, oh, here, auditors, this is how much they have. It's a good way to check the box to make sure what they're reporting is reality. That's cash. That's why it's so important. And what I like about it is every single year they generated $5.3 billion of cash flow. They put back 2.3 into the business for growth. But that means they still left $3 billion of cash money that you and I can get as equity owners. And if you go down to the very last line, right, so you've got $10 billion here of cash for the year. They only had to put $2.6 billion. They had very little debt payments. These are paying down or borrowing the debt payments, which was almost zero. That means they got $8 billion of cash that came through to the equity owners that were ours at the end of the year. That's tremendous. That's a lot of cash. And you'll notice most of these years historically were negative because they were paying down debt, which we covered earlier. Now debt is so low that they don't have to make these payments anymore. So this historical cash flow from operations is artificially low because they were paying down debt they don't have to do anymore. So going forward, I would expect higher cash flow from this business. Now, if I take cash flow to the equity owners and I divide it by shares, I get free cash flow per share. And that $15 number is a big, chunky number. I also want to point out that I love when I see businesses buying back shares, especially the ones that don't have to borrow to do it. And Target is an interesting company because they can both buy down debt and buy back shares. They're not using the financial leverage like, say, McDonald's is doing by borrowing money and buying back shares to artificially boost earnings. No. They make enough hard cash money that they can reinvest in the business, pay down their debt, buy back shares, and give a dividend to stockholders. That's a great, great thing. And what they've done is, on average, they're buying back 3% of the shares. That means, on average, every single year, you as an equity owner, we're getting a 3% return on your money without having to pay taxes. 641 million shares outstanding 9 years ago, just shy of 500 million. That is 150 million shares that they reached into the market, they purchased, and they tore up and they threw away. What means your stock ownership, the percentage that you own of the company, had you purchased it back then, is now higher going forward. With me? Okay. Free cash flow per share. Share price has spiked recently, right? Because both 2020 year was a great year and 2021 so far with 3 quarters in the bank are good years. So people are expecting continued growth. They're not going to have to pay down debt, so I'd expect cash flow to be higher. And as a result, share price jumps substantially. On a yield basis, that's an 8 times yield. Even when I look at this number today, if I take the current cash flow that's expected next year, divide by the share price currently, I think they're at, 108. We'll see this year. It's at a 9 times cash flow yield, so super strong yield. Let's forecast this business. But before we do that, I want to remind you that I teach a course at cashflowinvestingpro.com where I teach you how to read 10Ks, how to fill in a template like this. I give you this exact template, and I teach you how to read 10Ks for yourself to teach you to fish. You do not need to rely, or you can, on analysts that review stocks. The best thing to do is to learn how to do it yourself and do it every year for the companies you own. Check out cashflowinvestingpro.com for that course. Okay, let's forecast the business. So what we're going to do is we're going to pick up the EBITDA number that we had. And when I look into the financial markets, I can pull 3 quarters of earnings in 2021. So I have to guess at the 4th quarter earnings. And when I do 3 quarters of actual, kind of guess at 4th quarter, I get a 25% year-over-year growth in the EBITDA for Target based on those numbers. I then bring that down very quickly because I don't want to rely on 25% going forward. That seems completely wild, especially with the 8 years of kind of flattish growth that they experienced, right? On average, it looks like it's a 2% growth of earnings over time. So I give it a 25% because I think this year's going to be a strong year. They already have 3 quarters done. I'm going to say next year there's a tailwind of about 5% growth. And I bring it down really quickly because I don't want to pay for assumed high growth. I want a stock that I can give a very conservative forecast to and still have high returns on. That's the trick. Okay, so then I have that. That means I have at a target $13.8 billion EBITDA out 10 years from now, which is not unreasonable in my opinion. On an EBITDA multiple, I'm giving it 8 times EBITDA multiple, which means it's currently at 11-ish, 10.8, I think. I'm going to bring that down to a much more average. That's going to weigh on the stock growth. That gives me an $111 billion enterprise value. Basically have no debt and a little cash. So that's basically the same market cap. I divide by the shares outstanding, 498 million. I got a $222 price target for Target out 10 years. Let's take a look at cash flow. Okay, cash flow, they had a very robust year last year, right? So I'm going to follow that on with some higher growth, just like EBITDA, and I'm assuming they get that cash flow last year grows the same rate of EBITDA. That puts me just shy of $20 a share. I'm going to grow that very, very slowly over time, just like EBITDA, because EBITDA is translating through to free cash flow. I have a $24.49 long-term free cash flow price target, again, which I think they can achieve because they have low debt, almost no debt. So what we've seen historically where they're buying down debt is not going to happen. Going forward, I expect a little higher growth as they pass on inflation through to their customers. So I think it's achievable that they can do that. If I give it an average yield, 6.5%, which is a high yield because growth is low, I get $382 price target based on a cash flow method, which is a very, very strong value for the company. I want to remind you that I give one-pagers out on my website, cashflowinvestingpro.com, the Cash Flow Club, where I produce one-pagers on all kinds of stocks. I can only review one stock on YouTube weekly, but every week I'm releasing many stock one-pagers that give you 10-year historical financials. It gives you forecasts for cash flow and EBITDA, gives you a quick summary of what I think this company's going to do going forward, and a little chart. It also summarizes the 5 key factors over there on the corner for you for a very, very quick assessment of is this a good company or not. All right, let's take a look at the valuation of Target. So I got 2 valuations. I've got 222 based on enterprise value multiple method, and a free cash flow, I get $382 in the free cash flow. Now I don't know which one's which, so I'm gonna rate them 50% each. And I'm going to say a long-term price target of $302 for target. Now, I can look in the stock market today and buy as many stocks as I want for $216. Let's plug this into our IRR calculation and see what we get. Now, this stock is very interesting and it produces a tremendous amount of cash flow. When I line up the cash flow off the side, which is our estimate of the company's cash flow, they can either dividend that cash out, they can buy back shares, they can let it sit on the balance sheet, or they can use it to acquire other companies. This is our pro rata share. I'm paying $216 for this theoretical stream of cash flow. And in the end, I think the business is going to be worth $302. When I stack that up into an IRR calculation, I get a 15% annualized return IRR calculation, which is very, very strong. That's above market. And I would hope that if this comes through true, the company would beat the market going forward, which is exactly what we're looking for when we define well priced. Let's take a look at our 5 key attributes and summarize that. Number 1, top line revenue growth. Yes, it is strong last year, it's strong next year. Historically, it's been okay, low single digit, and we copied that in the forecast. So I checked that box. EBITDA, same thing, check the box. Strong free cash flow. Number 3, yes, absolutely strong free cash flow. Number 4, low debt. Yeah, it's almost zero. We can check that one. And well priced. I think that's so. If I give a conservative forecast of 2% out long term, even though 2021 is going to be a strong year. And I think what's going on is the cash flow that this stock generates so much is that it's really boosting the IRR. If I look at next year's free cash flow divided by the current price, the free cash flow yield is almost 9%. So for that reason, we're giving this a good stock. I like the conservative low debt. I like the strong free cash flow. I like the low forecast that's needed to produce an above market return. I think overall this is a solid stock. If I put that into an IRR matrix and just show the current price 216 at 15%, I would be a buyer of the stock up through 240-ish. But if it should fall, I think you'd start loading up. If you're looking for a strong cash flow machine that's safe and should underpin a good portfolio, I like what I'm seeing here with its value, and I certainly like its ability to push through higher costs onto the customer to maintain purchasing power. I think their scale provides them a lot of that. If you like what you've seen here and you want to learn how to do this, I teach a course, cashflowinvestingpro.com, where you can go, you can download my course. I give you this Excel model in Excel, you can keep it. I have 3 hours of lecture series where I show you how to read Apple's 10K, how to fill this out, how to make a forecast, how to think about IRR, and how to build a focused portfolio of, say, 20 stocks that are true rock stars. So you're not buying the average, you're holding the top of the best, and that would give you a good shot at beating the market and hopefully change your financial future for the better. So check out cashflowinvestingpro.com. If you don't want to do the work yourself, you can sign up for the Cash Flow Club, where every week I am releasing one-pagers on stocks that I find interesting, both overvalued, undervalued stocks, cash machines that I love. I publish them there, and it's a community of growing that we can talk through, and it's actually quite successful. So I hope you join it. Take a look. I also want to give some shout outs to people who have subscribed to the channel and commenting down below. I encourage you to like and subscribe. The YouTube channel helps me out, and throw a comment down below. Here's some comments from subscribers. Kingsley says, awesome sauce as usual. Cameron, how about Facebook next? That's a good one. I like Facebook. We can dust that one off, although I think I looked at it not too long ago. European dividend growth investor. I did a podcast with these guys. Great European dividend focused investors. Check them out on their podcast, European dividend growth investor. Another great video, Cameron. Really enjoyed it, and the value investing, dividends, and compound effect are truly the eighth wonder of the world. That's the old Einstein quote. P.S. Thanks again for being on the Dividend Talk podcast. Yeah, thanks, guys. I really appreciate it. We'll see you next year. Lastly, we got a comment, 6-minute intro into the video, and I'm already in love. Thanks, guys. Really appreciate the comments. Keep them coming. Tell me what you'd like to see down below. Also, check the videos that are coming out on the screen here in another second or two. I have more videos where I've reviewed over 100 stocks at this point. That show how to build a value-based portfolio, how to value cash flow. Check the videos that are coming up. If you haven't done so already, please like and subscribe, throw a comment down below. I greatly appreciate it. This is a hobby of mine, and it's going very well. Thanks, guys. My family, yours. Have a great 2022. We'll talk later. Bye-bye.